Hi investors! Today we're going to discuss about Moody's recent downgrade of Indonesia's credit outlook. On February 5, Moody's lowered Indonesia's credit rating outlook from stable to negative. The negative outlook was driven by, quote, reduced predictability in policymaking, unquote, and less effective communication, which can undermine policy effectiveness and points to weakening governance. However, the highlight is that this is not a credit rating downgrade. Indonesia's credit rating remained unchanged at Baa2. What is Moody's? Moody's provides international financial research on bonds issued by commercial and government entities for more than a century. Alongside Standard & Poor's, or S&P, and Fitch Group, Moody's is one of the big three credit rating agencies in the world. As a quick reminder, S&P and Fitch both rate Indonesia BBB with a stable outlook. So where is Indonesia on the rating scale? Indonesia is currently rated Baa2 in between Thailand and India. According to Moody's, Baa2 rating falls within the investable grade universe. How frequently does Moody's conduct reviews? Well, typically, the rating agency reviews country rating at least every 6 months. And if an outlook is changed, the agency will follow up with a formal review within 12 to 18 months. So the big question, why was the outlook of Indonesia downgraded? They mentioned several points. First, they highlighted rising political uncertainties, which will reduce predictability and lead to lower credibility. Second, Moody's seemed to be concerned with the governance and highlighted that government effectiveness and regulatory quality have become weak. Third, the agency pinpointed rising fiscal risks. Budget deficit could widen if government continues to place greater emphasis on social spending despite a narrow revenue base. Fourth, uncertainties with Donataro. Uncertainty surrounding the governance, funding, and impact of SOEs could raise concerns related to the sovereign wealth fund's contingent liability. Fifth, Moody's remained concerned about the potential increase in the 3% fiscal deficit ceiling, potential changes to Bank Indonesia's mandate and governance, as well as changes to policies governing the resources sector. The last concern is related to the financial sector regulatory quality, which I think they're talking about MSCI, driving financial market volatility. So now let's take a look at the bright side. Why was the Baa2 rating unchanged? Well, the rating agency highlighted that Indonesia still benefits from strong economic fundamentals, including natural resources and favorable demographics. Economic growth is stable at 5% YOY, and fiscal deficit is projected to remain below 3% GDP in the mid to short term. As we all know, Indonesia's fourth quarter GDP in 2025 came in at 5.4% YOY. Also, government debt remains low compared to peers. If we compare Indonesia's debt to GDP, we can clearly see that it is one of the lowest in the region. All in all, macroeconomic stability remains a key reason behind the Baa2 rating. So, how did market react to the news? Well, we don't think market is overly reacting to the news. The stock market is down 2%, government bond yields inched higher, but not overly so. Credit spreads and rupiah movements were also broadly expected. At the end of the day, Moody's didn't downgrade the country rating, but only the outlook. We think the market reaction today is broadly natural, and we expect to see no doomsday surprises. Now, let me walk you through the worst-case scenario, a scenario whereby Moody's actually downgrades Indonesia's country rating. The first direct impact will be higher bond yields. Borrowing costs will go up, and Indonesia's economy will be suffering from higher debt repayments. Next, when yields go up, discount rates go up as well, and this will drive asset prices lower. We might have to expect a decent drop in risky assets, including stocks and property. We also might witness a massive outflow of capital, ultimately driving the value of the rupiah lower. Following the rupiah weakness, there could be a spike in inflation due to higher import costs. This will prompt the central bank to increase its policy rate, and the cycle repeats itself. So how can we get back to the stable outlook? We don't think it will be difficult. The answer sheet is already provided by Moody's. Indonesian government will need to, number one, improve policy credibility by making policies clearer and more consistent. Number two, show commitment to reform. And number three, outline policies conducive to macro and financial stability. In terms of numbers, Moody's will be closely looking into two things: government revenue and economic growth. Then, what could lead to a downgrade? In the event Indonesia's government were to continue spending aggressively without a revenue reform. Secondly, a deterioration of the external position, such as prolonged rupiah depreciation leading to capital outflows and weak debt servicing capabilities. Thirdly, significant weakness to the financial health of SOEs, which are tied to Danatara governance. Collectively, they are likely to prompt Moody's to downgrade Indonesia's sovereign rating. So the moral of the story goes like this. Moody's downgrade is not a rating downgrade, but an outlook downgrade. We consider this to be a wake-up call and not a call for panic selling. There is no need to overreact in our view. Secondly, Indonesia will respond to the requirements outlined by the rating agency. Moody's already gave the answer sheet to the government, and we are confident that the officials are going to tick off all the checkboxes. Our imminent concern is whether this will trigger other rating agencies to follow suit. A while ago, S&P announced that it will release an official report in April. Last but not least, we have been recommending investors to trim their risk exposures in their portfolio, and we recommend consulting with Samuel representative. If you've enjoyed the contents, please like and subscribe and leave comments below. Thank you.